We're starting the week off with Gary Wagner and price forecasting up next. We start the week with Gary Wagner. He joins us from Hawaii. Gary, thanks for being with us.
My pleasure as always.
Gary, we'll be looking at tools that can help with price forecasting today. But before we get to that, I'd like you to start things up by filling in this sentence for me. Gold could get over 1,400 within the next 6 weeks if
we break through a critical level of resistance, which is the last high roughly at 1345, I really believe that if we're able to have prices move above that on a closing basis, we have a real opportunity to see this rally continue to build.
And gold obviously reacting to this talk of taper. Gary, what do you make of it when the Fed is always set to speak?
Well, there's two things I think I can do. The first is just hide my head in the sand, because the statements that come out increase the volatility so much in the market. It really puts us on shaky ground. But what I do is I look at my technicals, because technical indicators are simply a mathematical distillation of the fundamental data that's out there, and it's easier for me to look at numbers than changing data sets, meaning one Fed president saying one thing and Bernanke saying the other, and the market's reacting back and forth.
What's keeping you optimistic, Gary? Because if you're eyeing gold over 1,400, that's obviously a positive point of view.
Yeah, well, and the insert will talk about the particulars of why I feel this way, but I think that once we hit the low and the market moved below 1,200, that incredible sell-off, when you consider it went from 1,800 to below 1,200, the fact that we saw it move up so quickly and so dynamically, coming off of those lows, breaking back above 1,300, to me is significant. So we've seen the market move $100 plus off of those lows, and the question is, will that rally continue?
And we'll get to your insert, Gary. Overall, technically, however, there's not much new. Is it correct to say that December gold future bears continue to hold the overall near-term technical advantage here?
Well, absolutely. We came off of the lows, and even though we've moved $100+ higher, when you look at a daily or a weekly chart, the trend has been down. And until we reach certain benchmarks on the upside, we could still be just looking at short covering and other reasons for the market to be moving up, and it can give us that false sense. Absolutely correct.
So we're going to get to your segment now, Gary, on price forecasting. How can investors use these tools to get a better gauge of what's happening on the metals front?
Well, forecast modeling is nothing new. And the key to that is when we look at markets in terms of a historical perspective, we can see that if the market hit a certain price point and reacted in a certain way, all we're really doing is saying that if it hits that price point again, there is a higher probability that we might see a resistance or support level that was actually created during that price peak or that price valley. And so we're looking at that to determine where we think the market might go, where it's going to run into resistance, where it's supportive if the market's under pressure.
Excellent. On that note, we'll get to your insert right now.
Certainly. The art and science of technical analysis is really the ability to take information and put them together, much like a puzzle. However, with this puzzle, you're dealing with a series of Russian dolls that, defined within the Elliott wave, is a micro and macrocosm, and we touched upon that last week. And so in this week's insert and edition of Chart This, what I really want to do is talk to you about a couple of different models that we had unfold during this last correction, where we're at, and how this most recent rally has kind of given us some pieces of the puzzle that are clarifying our exact point in terms of where we are. Although we're not out of the woods quite yet, we really have this large triple harmonic in terms of gold prices that I really need to see it exceed before we get the final feather, so to speak, that we're absolutely in a defined rally. Let's take a grandiose view of it at first, and what we're going to look at is going to be a weekly chart. It's in Japanese average format, and it's quite clear when we look at this chart that we've got something different going on than we have in the past. And the past that I'm talking about is this recent fall from grace, so to speak, from, call it 1,800 to below $1,200 per ounce. Quite a sizable drop. Now, on the Japanese average charts, they filter out noise by looking at the midpoint. In other words, the way that these candles are created, in essence, if it opens above the midpoint of the prior candle, so the prior week, it's green. If it closes below the midpoint of the prior week on a weekly chart, it's red. What happens is, even though this market's coming down, you get a little bit of green and it follows in suit, just like we're seeing down here. When we look at the size of these candles and the duration of this attempted directional change from down to up, it fails in all occasions. So what you're really getting here is basically short covering small rallies in the market that aren't substantial because they're simply points in time in which the market's consolidating before it continues to drop. However, take a look at this most recent activity, and this is up till last week when this insert was created. Market is currently trading at 1309 to 1312. If you look at the candles for these last weeks, they are absolutely different than what we have seen prior in terms of any kind of attempted rally. Secondly, we're looking for it in a place that makes logical sense. When we take this entire move, which is from 728 to 1900 plus, and we look at the bottom or the conclusion, the lows that we have seen, the 61% retracement level, 1191, and I believe the low was 81. So it's a very, very logical point to look for a conclusion in the most current trend that we have. And of course, the best way to do that is to move away from our daily, this being a 2-day chart here, or our weekly, and move to some intraday analysis. Following the move from 1480 down to 1180, tremendous drop in price, we had the first spurt, or this rally, which really took us off these lows from 1180 to an intraday high and a top of 1348. That's why 1348, along with 1339, are key resistance levels. From there, the market corrected or retraced, and when we look at that retracement itself, this would be a 50% retracement. This is, of course, a subcount again. And so what we will have is this is 1, 2, and my belief is that we are at the beginning of our third wave right in here, and it's going to be these 5 waves that make up the intermediate 1. This is our intermediate count right here, this wave 1, 1, 2, 3, 4, 5, all collectively is our major count right in here. So on the top of this, I believe we have wave 3 as our major count, this being wave 4 as our major count. We're now in wave 5, a major 5th wave, but we've just started this 5th wave off of this C. And so what we're really focusing on and concentrating on is this wave 1, this intermediate wave 1, which is the count I believe that we've just started. And to look at that in detail, I've gone ahead and pulled up a 480-minute chart. This is the subcount of 1, and this subcount of 1 is composed of a 1, 2, 3 would be here, 4 would be here, and then this would be 5. I also believe that the most recent sell-off that we witnessed, in which we saw the market going from 1349 down to 1270, I believe that it concluded here, and we are now in, as I said, the beginning of an intermediate 3. Now, one of the beautiful things about Elliott wave models and forecasting is that once wave 1 is actually concluded, it allows us formulas to look for where we can expect the termination of 2, and then most importantly, where we think that wave 3 might take us in terms of the upside. The beautiful thing about that is that by nature, wave 3 cannot be the shortest of any of the impulse waves. So that in terms of where it might go, we can simply do an extension, and by doing a Fibonacci extension from wave 1, we can ascertain really what we're looking at for wave 2. So as you can see, I'm simply putting a start and an end point to our wave 1. I'm then going to be taking it to the actual low or the beginning of wave 3, and then we're going to look for different areas in which we might see this market trade to. What this model is telling us is that if wave 1 and wave 3 are of equal size, then we could in fact be looking not only for gold to take out 1400, but actually to rise as high as 1434. Looking at the most recent market activity in gold, I'm excited again about the possibilities. I want to thank you for your support. And as you know, we offer additional bonus content for those that want to dive into the market a little bit deeper. I did a 45-minute webinar, a live webinar last week, and I have a recorded version of that, and that will be available for viewing. All you have to do is go to the Kitco bonus content page. To do that, simply pull up thegoldforecast.com, scroll to the bottom as you know, click on this copyright right here, Elliott Wave and model forecasting in gold.
And Gary, thank you so much for taking the time to prepare that for us.
Oh, my pleasure as always.
And thank you for watching this edition of Chart This with Gary Wagner. You can email us at newsfeedback@kitco.com or follow this conversation on Twitter @Daniela Cambone. Thanks for watching.